Hi everyone, welcome back to the US CPA classes for business analysis and review exam. In this particular video, I'll be walking you through in detail about business analysis, and more specifically, we'll be covering the topic called risk management. So let's understand more in detail about risk management.
Hi everyone, welcome to the US taxation. Oh, sorry, BAR classes, business analysis review classes. So, in the last classes, we were discussing on 2.2.3 investment alternative, and today we'll be starting with 2.2.4. So, quickly, I'll reiterate what we have studied in the last two classes. I know it's been almost 2 weeks gap because of Diwali holidays, right? So maybe you might have skipped something in your mind. So just quickly walk you through what we have studied in the last week, basically, and then we can jump on to 2.2.4, which we need to start today. So I'm hoping like this week or next week probably we'll be in a position to finish off the BAR. So last we have studied on investment alternative using financial valuation decision model. In that we have understood financial valuation methods as well as decision model, which include like valuation fundamental, valuation assumption, valuation methods, assets and investment management, and capital budgeting technique. So in that we have studied for valuation fundamental, basically what is fair value basics. Then after we discuss about like approaches to determine fair value, and simultaneously we covered the assumption when using the fair value, which is like cost approach, market approach, income approach, and other relevant approaches. Then we discuss about fair value hierarchy, level 1, level 2, level 3, and lastly we discuss on disclosure part. So 1 and 2 topic we have covered together. Then we jumped onto the Black-Scholes model as well as capital asset pricing model and dividend growth model. So CAPM and dividend growth model we have already studied in the earlier class. So in last two classes we discuss about Black-Scholes model. Right after that we jump onto the assets and investment management, where we discuss about portfolio management and investment process. And lastly, in the very last class, we discuss all about capital budgeting technique, which include like fundamental of capital budgeting, time value of money, payback period, discounted payback, accounting rate of returns, net present value, internal rate of returns, profitability index, and CVP analysis. So these all things we have covered in the last two classes. Hope you guys have gone through the notes, or like if you have any doubt, I'll be more than happy to answer. And today we are jumping onto the topic 2.2.4, which is about the risk management. So today we'll target to cover at least key elements or financial risk management, and then tomorrow we'll cover remaining two topics, which is mitigation control or exposure of type of exposure. But if time allow, we'll try to cover those topics as well. It's not very big topic. So in the risk management, so what do you understand by risk management when it comes to your mind, when anyone say what is risk management? Any idea, any thought you would like to share from your side? Hmm?
So it is basically like dealing with the uncertainties, like
Mm-hmm. Okay.
how much risk we are able to take in the
Mm-hmm.
particular situation or anything.
Mm-hmm. Okay. What else? Yeah, Arun, Manish, Sapnil, any thought you guys would like to add? Mhm. Have you heard this term before? Risk management, by any chance? Surya, Manish.
Yes, come on.
So, any idea what is risk management? Any thought, any understanding you may have? Like, don't worry, no one is judging you, no one is giving you marks. Hmm? As a layman, what do you think? Like, what will be the risk management?
So every type of business will be having certain types of risk. So
Mm-hmm.
in order to manage those risks, there will be a set of policies. and a
Yeah,
team working on
yeah. Very good point. Yeah. So, like both of you, like Kashish and you, both of you, like very rightly pointed out. First, like we need to understand what are the risks will be there in a business, right? So it can be the risk at the entity level, it can be risk at the process level, it can be risk at the market level, geographical location level, product level, or segment level, right? So first we need to identify what all risk could be possible. That means what all things can go wrong for a business, right? So anything and everything which you foresee can go wrong for the business can be considered as a risk. Then, with those risks, we need to identify what can be like the material risk, or what can be the significant risk, what can be financial risk, what can be operational risk, or what can be immaterial risk, right? So, like as a businessman, first we are discussing about like business. So, as a businessman, we always need to focus on the domain or area where the risk is high, and we should have some materiality in our mind when we are evaluating any proposal or when you are evaluating the overall risk, right? So the items which are not material, I would say as a business owner, as a businessman, we should not too much worried about it. But the item which have like significant risk, or you can say fraud risk, or risk of material misstatement, right? So those are the risks where we need to focus on, right? So first of all, as a business owner, we need to identify all category of risk. Then second step, we should have like what all risks are material, or you can say significant, or maybe have some fraud risk, right? And then third step will come identifying the controls that can mitigate the risk, or maybe making a strategy or building a strategy what all risk you can accept. That means you are comfortable accepting those risks. Maybe it's a pilferage, or it may be a not some material, it may not result into any material misstatement. And what are the risks which you can pass on to someone else, maybe to the vendor, maybe to the customer, maybe to the insurance company, maybe to the transporter, maybe to the supply chain manager, management company, maybe some technology company. So those all things you need to identify what all risk which you can pass on to third party and safeguard and protect yourself. Third thing is about managing the risk. So whatever is the remaining risk is there, how you can manage those risks. It means what all control you should put in place to manage those risks, right? And then after to those controls, there will be continuous monitoring and review process. So this overall exercise is called risk management process for any organization, right? In this risk management process, very first thing what we do, identify all business risk, right? Yes, no,
Yes, sir.
right? So within those identify risk, you need to further categorize what all risks are not material to the financial statement, right? Second is what all risks are material to the financial statement. So the risks which are not material to the financial statement, that can be classified as a risk which you are ready to accept, ready to take, right? The risks which are material to the financial statement is further subdivided into two categories. First category, out of those material risks, what all risk you can pass on to third party, right? So that is like transfer of risk. And remaining risk, how you are planning to manage those risks. So for that, you make a risk control matrix, right? In that risk control matrix, you'll be identifying what all risks are there and what all controls you are putting in place to mitigate those risks, right? And then after, you'll put like continuously monitoring and review process. That's control you have put in place. If the controls are not operating or not even like completely not operating or not operating effectively, then there is no use of those controls, right? So there should be a continuous monitoring and review process for the controls which you have identified to mitigate the risk of material misstatement, right? And then what will be the exposure? So if you see the very first column over here is in the risk management, what are the key elements? So when we are discussing, so what we have discussed as of so far to give you an understanding from the company broader perspective. But here we need to focus more on financial risk management, right? So what all are the elements of financial risk? First is interest rate risk, right? Any idea what is interest rate risk? Maybe any thought you can give?
Use of interest in a particular country in order to combat inflation.
Yeah. So, like, do you follow like RBI repo rate, or maybe RBI has increased the repo rate, reduced the repo rate?
Yes,
Have you heard this such kind of news? Right. So, what is the impact of increase in repo rate? That means interest rate go up, right? When they reduce repo rate, interest rate go down,
no,
right? And then banks sometimes pass on the decrease in interest rate, sometimes they do not pass on the decrease in interest rate, or they do not pass on in the same proportionate as RBI do, right? It's very common, yes or no?
yes, sir.
So increase or decrease in interest rate, how much it will impact your cash flow? That is called interest rate risk, right? If you have for example, if you have any borrowings and you have considered at, you can say, fluctuating rate, right? So that keep on moving, the outflow of your cash will keep on moving based on change in the repo rate or LIBOR rates, right? So that result into interest rate risk. Make sense? Second
Yes.
is foreign currency risk, right? What is foreign currency?
Like for importing and exporting of goods and services, then we will, foreign currency will come into picture.
But what do you mean by foreign currency?
So at the
Please.
rate at which, our currency is going to be exchanged.
No, my question is very basic and very fundamental. What is foreign currency? Currency of any country outside the United States of America is called foreign currency,
Yes,
right?
yes, sir.
So second come, what is exchange rate? So what you are telling, Kashish, is exchange rate,
Yes, sir, that is
right?
exchange.
At
Yes,
which my country currency will get exchanged in the open market with other country currency, right? So, like these all rates are keep on fluctuating every moment, right? Same way how stock price of listed company keep on moving based on buying and selling of the respective stock in an open market. Same way currency price also keep on changing based on sales and purchase of the respective currency, right? So there's always be a risk of foreign currency rate changes. That means fluctuation of foreign exchange rate. Make sense?
yes, sir.
Third is price risk. Like something which you have purchased last year and this year it has gone further expensive because of inflation impact. And same way it will increase or decrease in the future period. If it is a like stable product, probably it may increase. But if it is a technological product, for example, mobile, right, or maybe laptop, then it will keep on reducing because of new upgraded version would be coming. Make sense? So that is called price risk, change of price of the respective product or service in future period is called price risk. Make sense?
But how is that a risk? So, like at different point of time, the price will change, right? But how will that be a risk?
Yeah. So, for example, like you are importing, let's say, I would say you are importing petroleum product. Let's assume polyethylene, polypropylene, such kind of product you are importing for manufacturing of plastic product, right? Polyethylene and polypropylene are basically used to manufacture the plastic product, right? And that you are purchasing from international market, right? And their price are being fluctuating every moment. So it will impact your purchase cost,
Okay.
right? So
Okay.
sometime, like you may keep in mind like the up to increase or decrease in this much price level, I can absorb in my costing. But beyond a point, if price are increased, I need to pass on to the customer. That means it will impact your sales price also, right?
Okay.
So that is called price risk. Next is market risk. When there is a change in demand or change in supply, right? Or maybe you can say new market has opened for new product or services. That may result into a market risk. For example, like any of you have heard about Chat GPT?
Yes.
So it is creating a disruption in the market, right? So a lot of things are going to get changed because of the Chat GPT, right? Same way, have you heard about? I think I have already taught you cryptocurrencies, right?
Yes, sir.
Right. So cryptocurrency is what? It's a digital currency, right? Which has no backing of any country reserves, right? Normally, if you see the currency, that means rupee or dollar, whatever you have in your hand for the purchase, that has backed up by the respective reserve bank of the respective country, right? Same way, if you have some money in the bank, that also being backed up by the reserve bank of the respective country. But if you see, the NFTs have no backing of real currency, but still people are using it, right? And now the country have started making law of recognizing these cryptocurrency for the calculation of taxes, because transactions have already started happening in the currency. And future of the cryptocurrency is NFT, non-fungible transaction also, right? So that's a market risk which no one have, like thought 10 years ago that any such currency will come. And maybe slowly and gradually you will see 5 year or 10 year down the line, it may disrupt the actual currencies, right? If you remember, like earlier days, there was like first time when computer came, right? So that has also disrupted the market. Same way, if you see like in the banking industry, earlier we used to do most of the transaction in cash. Then we started using banking. Then we started using debit card, credit card. Then we started using mobile wallets, right? Now it is like cryptocurrency, and future will be NFTs, right? So those are like kind of market risk. A lot of things get disrupt out of it. Same way, if you remember, like earlier days, many of your friends, family member, or a relative might be using mobile phone of like Nokia, but because of all the technological change, it's no more there. right? Same way, if you remember, like old days, there were big cameras. Almost we all may have some or the other clicks from it, right? But now it's all in mobile. No one generally purchases camera unless until he or she has like the very deep interest in the photography, right? Next is liquidity risk. Any idea what is liquidity?
Conversion of assets like stock into cash.
Yeah,
Maybe
basically cash in hand. So liquid money in your hand, right? So many businesses, reach to a closer stage because of the lack of the liquidity, right? When you are running a business, managing the cash flow is also very important, right? So if you do not have liquidity in hand, then it will be difficult for you to survive in the long run for your business, right? And if you, on the other side, if you have good liquidity in hand, then you can take bigger risk in the market. And as we know, like we all are like commerce and management student in 11th standard, I'm sure each one of you might have studied this line: risk and rewards moves together, right? So if you have good liquidity in hand, that means you have a good capacity to take risk, right? Next is credit risk. Any idea what is credit risk maybe?
availability of loans.
Have you heard like CIBIL score by any chance?
Yes, sir.
Any of
Yes.
you have taken any loan by any chance?
Yes, sir.
Right? What banker do? They check your CIBIL score,
Yes, sir.
right? What is the CIBIL score is all about? It shows how credible you are. Whether as a bank, can I provide loan to you or not? If I can provide you the loan, up to how much amount I can provide you, right? And what will be the rate of interest I should charge you based on your credit worthiness, right? That is called a credit risk. Or another thing also include here, when you are giving lot of sales on credit, how much amount you are actually collecting and how much it go to the bad debt. Those all things comes under the credit risk. Make sense?
Yes, sir.
Yes.
Next is default risk. Default risk is the risk that you may not be in a position or not able to live up to the commitment which you have given, right? It can be financial or it can be non-financial. So failure to such things may result into default risk. That means you may get into any default for payment of loan, repayment of loan, or maybe payment to the vendors or creditors, right? Next is systematic risks like inflation risk or any other risk which systematically increase or decrease. Next is counterparty risk. That means competitor risk, right? So first, what you need to do as a businessman, you need to identify, these all are illustrative list, not an exhaustive list. And here we are discussing more about financial risk. So in the financial risk, these are certain key risks, or you can say very commonly identified risk. And again, I'm repeating, this is like illustrative, not exhaustive list, right? So risk may include your interest rate risk, foreign currency risk, price risk, market risk, liquidity risk, credit risk, default risk, systematic risk, and counterparty risk. So once you have identified all the risks, then what was the next step? Identifying which risks are material to the financial statement and which risks are not material to the financial statement. The risks which are not material to the financial statement, you can accept those risks, right? So the financial risk management process include accepting the risk, second is transferring the risk, and third one is mitigating the risk, right? So you understood what all risks you can accept? Clear?
Yes, sir.
Now the remaining risk can be further delegated or pass on to the vendor, to the customer, to the transporter, to the insurance company, or to any third party. Right? That is called transfer of risk. And any remaining risk which is material to the financial statement, you are ready to manage that risk. So when you are managing the risk, the next step will be putting the mitigating control to manage those risks. Right? So we'll be discussing in detail about one by one the processes and control you should put in place. Right? The last one is type of exposure. So what all type of exposure you'll be getting in this entire process? From like the one company has a subsidiary in country outside United States of America, or how to deal with, you can say, holding and subsidiary company which is located outside India, right? So these all things we'll be studying in detail. So any doubt high level before we jump into the main course?
No, sir, clear.
So far so good. Okay. So first one is financial risk management. So it's the process of dealing with uncertainty resulting from event in the financial market. It involves assessing the financial risk facing an organization and developing and implementing management strategies and process consist of organization internal priorities and policies. So very first thing is identifying all category of risk, right? And categorizing those risks to the material and non-material, and to those material risks, building a strategy or policies in place to mitigate those risks. That means implement the controls around those. And the lastly, monitoring of those. Firm must decide which risks are acceptable and which are not to its resources. Adopting strategies need to be evaluated, monitored, redefined as a market condition change. That is, for example, change in market rate, business environment, international and political consideration. So, like we were discussing earlier, first is, as a firm, you need to decide which all risks you can accept and which all risks you cannot accept. Right? For the risk which you cannot accept, there should be a strategy that need to be evaluated, and the controls must be put in place, and timely those controls need to be monitored and reviewed. And if there is any change in circumstances or change in market condition, then you need to reassess and reevaluate those controls. Right? Any doubts so far? Yes? No?
No, sir.
So far so good?
Yes, sir.
Okay. So financial risk management is a component of enterprise risk management. If you remember, in the very first chapter of the BEC, we have studied about the enterprise risk management, right? So financial risk management is a part of enterprise risk management, right? So the financial risk management is a component of enterprise risk management of the firm, which include the items such as business risk, operation risk, supply chain risk, product liability risk, and potential and economic risk, right? So these all things you need to keep in mind when you are evaluating the overall risk at a bigger level. Now we are jumping into the main course, which is first item, that is key element of financial risk management, right? If you remember the key element of financial risk management, we have considered interest rate risk, foreign currency risk, price risk, market risk, liquidity risk, credit risk, default risk, systematic risk, and counterparty risk, right? So same we'll be covering here. The first A point is interest rate risk. Then second is currency risk. Then after we'll be discussing price risk, market risk, liquidity risk, credit risk, and other risk, right? And then we do certain practice question. So these all things will be covering as we are discussing. So first is interest rate risk. Interest rate risk arise from difference between the timing of interest rate change and the timing of cash flow. Cash flow mean when you are actually receiving the money or when you are actually paying the money. So interest is generally in between this period when you receive the money and when you pay the money, right? If you have taken any loan, that means at the time of receipt you got the money, and when you will be repaying it back, till that time you will be paying interest, right? So that interest which you need to pay it back is always be on some price risk, right? So repricing risk is the risk of generally price increase on account of inflation and other general reason, generally not in control of individual firm. So here we are talking about small firm. We are not talking about big company. To those small companies, basically, when they discuss about risk, interest rate risk, right? So which may result on account of change in interest rate in future, and if they have any such things which may result into, I would say, uh, fixed rate of interest, right? To, or you can say, where you can control that the price or fluctuation of price will result into the same amount of interest. So that is called a risk, repricing risk. So risk of general price increase on account of inflation and other general reasons. So generally not in control of individual firm. So it is being controlled by the market, not by the individual firm. Make sense? Same way, like how stock price of SEC listed or maybe any other stock exchange listed company fluctuate. So that is not in control of any individual. It is being on account of result of multiple people from the multiple places who are purchasing and selling those respective stocks. Right? Make sense? Repricing risk. Second is basis risk. So a retail bank generally funds loan from customer deposit. That is basis of loan. And if interest rate for loan increase, customer also expect more of their deposit. So for example, if Reserve Bank has increased the repo rate, what will be the impact of the same? It will increase the interest rate of loan and borrowing, right? At the same time, when interest rate is increased by Reserve Bank, then the public who have deposited money to their respective bank, they will also push to the bank to adhere to those circulars, right? And then they have to give you additional interest. Make sense? Yes, no?
Yes.
Okay. Third is yield curve risk. So what do you understand by yield curve risk? Any idea? Have you studied like this trigonometry in 11th or 12th?
Yes.
So it will be part of it. Yield curve risk. It is the risk of experiencing an adverse shift in market interest rate associated with the investing in a fixed income investment. That means when market yields change, this will impact the price of fixed income instrument. Like, have you heard about municipality bond, government bond,
Yes, sir.
debentures,
Yes, sir.
right? So those all things are generally fixed interest bearing instrument, right? And how their price are changed. So their price are changed on account of change in the yield of equities or available funds in the market, right? What does mean? If, for example, like you have, let's assume you are a company and you have issued a 5% debenture of $1 million at the face value at $1 million for 5 years, right? And now next year, the market rate of interest has decreased from 10% to 6%. So what will happen? You need to increase the price and reduce the basis, right? If you are reducing the basis, it may result into more interest, but that will be going to the individual account, right? Make sense? Maybe let's take through an example. Let me open an Excel sheet. So, for example, you are a ABC corporation, you are, right? Issue 10% bond at face value of $1 million, right? So face value for 5 years. After year end 1, interest rate, or I would say market interest, market interest rate has gone to 8%. It's gone down to 8%, right? So as interest rate of the market has gone down to 8%, but you are paying 10%. So the value of your debenture or bond will increase or decrease. Are you guys with me?
Yes, sir.
Increase.
It will increase, right? So let's year-end value will be this multiplied by 10% divided by 8%, right? So the value will increase. Make sense?
Yes, sir.
$1.25 million. So this change in value is called yield curve risk, right? Change in value on account of change in interest rate will result into yield curve risk. Make sense?
Got it.
Last one is option risk. It arises from legal right to engage in a future transaction at a predetermined price. So it can be put option or call option. Have you heard this term before? Put option or call option?
Yes, sir.
What is put option? What is call option? If any of you can just explain based on your understanding. What is call option? What is put option? Put option? Come on,
Call
come
of
on.
calling of additional investment from the investors, right?
What is put option?
I haven't heard of it.
Any rough thought?
The call option is basically right to buy, and put option is basically right to sell.
Yeah, more or less that's right. Swapnil, Manish, Arun, any other thought? Yeah, in a layman language, what you're saying, Kashish, is right. But let me help you understand more in detail. So, for example, like today you are a company. Let's assume you are an ABC Private Limited in India, or maybe let's assume ABC Company C Corporation in United States of America. Right? ABC company has taken an external commercial borrowing from Europe for, let's assume, $1 million. So today the interest rate in US is, let's assume, 2%, and in Europe it is 3%. Right? So after 3 months you have to make, let's assume, payment of 2% interest plus the $1 million borrowings which you have taken from your cousin who is settled in US. Right? So what will be the difference? Are you getting my question, or shall I type on Excel sheet? So the question is very simple. You have taken an ECB, external commercial borrowing, of $1 million. Right? Payable after 6 months. Right? And ECB from London Bank, UK. Right? So you have taken an external commercial borrowing from London Bank, UK of $1 million, which is being payable after 6 months. So in euro. Right? So today you have taken euros, and after 6 months you need to pay euro back. Right? Along with, let's say, interest. So interest, let's assume, is around 50,000. So how much total euro you need to pay? 1 million. How much euro you need to pay? Yes, no. 1,050,000 dollars.
Yes, sir.
Right?
Yes.
So now you want to, at this point after 6 months, there may be different currency exchange rate than what it is today. Right? So you want to purchase an option that after 6 months I will pay you this much amount of dollar to purchase 1,050,000 euro, so that I can pay to the library and be the part of that library. Hello? Are you guys here?
Yes, sir.
So 1,050,000 you need to pay after 6 months. So today is exchange rate will be different, right?
Yes.
So you can make a deal with the bankers that I will purchase this much euro after 6 months, and you can deal at a price. Let's assume today euro and US exchange rate. Let me see. 1 second. So today rate is 1.09. Euro to USD after 6 months. Is, let's assume there may be some better option. Yeah, can you see this chart left hand side? So it may increase by 0.0064. So this is what, like expectation, that this will be the pricing, and this is how you can identify. So 0.0064 it is showing. One 0.08, let's assume, just for the simplicity I'm doing it. Right? So today you can make a deal with the banker that I'll purchase 1,050,000 euro at 1.08, and you pay some commission to the bank. Right? So after 6 months, you'll be having a right to purchase the euro at $1.08. If euro price is more than 1.08, then you will be exercising the right. Yes or no? If after 6 months euro price is more than 1.08, then you will exercise the right so that you can purchase the euro at 1.08. But if after 6 months euro rate is 1.06, then you may not exercise the right, because not exercising the right may give you cheaper option. Make sense?
Yes, sir. 1.08 में भी तो sir we need to pay extra amount ना for the commission to the bank. तो sir वो
Yes,
automatically
yes.
तो automatically sir उतना ही पड़ेगा वो भी.
It depends on volume. No? It depends on volume. If it is like 1,050,000, probably that transaction cost may not be that big.
Okay.
Right? Any doubts so far?
No, sir. Clear.
So yeah, first is about put option. The owner of a put option has a right but not the obligation to sell a given quantity of the underlying asset at a specified strike price during the specified period to the seller of put if the option is exercised. These put option protect against the risk of decline in the market value. So put option is basically right to sell. Right? For example, you sell, let's assume you sell wheat bags, right? So maybe 50 kg wheat bag you export from India to, let's assume, Middle East, right? So in this case, like you entered into an arrangement with any exporter. So let's assume you are in United States of America and you are exporter of, let's assume, wheat. So your exporter is in Middle East. Let's assume Dubai. So you entered into an arrangement with the vendor that he or she will be purchasing these many bags at this particular rate during the year or at that particular period, right? And that is a contract, like which is being binding contract, that at this particular price you'll be selling it. So that options are generally called put option when you have a right to sell at a particular price. And when do you exercise the put option? If the price, actual price, market price is below the contract price. That means you'll be in a position to sell at higher price. On the contrary, call option is right to purchase, right? The earlier example which we were discussing about external commercial borrowing, that means after 6 months, if you have to purchase €1,050,000, right? And you have taken a call option, that means after 6 months, you can purchase the euro at this particular price, right? If the prices are more, then you'll be exercising the call option, right? Make sense? Clear? What is call option and put option?
Yes.
So put option will give you the right to sell and call option give you the right to purchase. And you will exercise the right only if it is being beneficial to you. Otherwise, you will allow the right to lapse. If it is not favorable condition to you, why will you exercise the respective option? Make sense? So far clear?
Yes.
So next is interest rate. So there are 5 category of interest rate. First is basic interest. Second is discounted interest. Third is add-on interest. Fourth is simple interest. And fifth is compounded interest. So basic interest is very simple. Interest expense divided by amount of loan or amount of borrowings. Right? Very simple. Second is discounted interest. Discounted interest is basically interest paid divided by amount which you have actually received. Right? So the total borrowing actually you have received in hand. So that is called discounted interest. Add-on interest is calculated to identify monthly repayment. Same way how you have EMI schedule for your loans, which has principal plus total interest payable divided by number of payments, right? Next is simple interest, which is periodic interest multiplied by number of days multiplied by outstanding balance rate. And compounded interest, that is interest on interest, total period principal multiplied by 1 plus interest rate divided by number of times in the period, number of months payment is making, right? This is very simple. I'm sure you might have studied in your school days, right? Hope you don't need any additional information.
Clear.
So why interest rate differ from borrower to borrower? So this is also like another topic which you see might be frequently tested in your examination. Interest rate are generally different from borrower to borrower. So what are the reason of different rate of interest to the different type of borrower or different individuals, right? Same way, like when you take loan, whether you take personal loan, home loan, car loan, any such loan, right? For each individual, it is being assessed separately, right? And has been provided separately based on what all parameter, like bank who is providing the loan is considered. First thing is the risk profile of the respective borrower, right? So the very first thing any banker or any financial institution is look for is your CIBIL score, right? Make sense? Second is the category of loan. So if it is secured loan, then interest rate will be less. If it is unsecured loan, then interest rate will be high. Make sense?
Yes, sir.
Third is period of loan. If it is short term, then probably interest rate is low, but if it is long term, then probably interest rate will be high.
नो सर उल्टा होगा ना, अगर शॉर्ट टर्म होगा तो सर
Sorry, if it is short term, then interest rate is high, and if it is long term, then interest rate is comparatively low, right? Fourth is other economic factor. If you remember, we study one topic called hyperinflationary economic. Do you remember that?
Yes, sir. You have given the example of sir, Pakistan
Yeah,
and
yeah,
Afghanistan,
Bangladesh, Sri Lanka,
Bangladesh, Sri
Afghanistan,
Lanka.
yeah. So where, the inflation rate in 3 year increased more than 100%. That economic is called hyperinflationary economic, right? So in such economic condition, these things also impact to the interest rate, right? Maybe the individual who is staying in India, for them interest rate may be different, but the person who is staying in any hyperinflationary economic, the interest rate for that person may be different, right? And the lending laws, so law of the country. So RBI in India, they govern the interest rates, right? So they have certain basics rate, or you can say interest free rate. So any bank do charge premium on that rate. Same way, Reserve Bank in United States of America also issue the guidelines for the borrowings, right? So these all factors are always being considered in mind when you are providing the borrowings, and it result into impact of interest rate for the respective individual as well as respective corporation, right? Method for quoting rate of return. So annual percentage rate, which is period interest rate multiplied by number of period per year. For example, 2% quarterly is equal to 8% annually. 4% semi-annually, it can be 8% annually. Second is effective annual rate. So that is 1 plus rate per period, the power 2 minus 1. Therefore, rate per period is equal to APR divided by period, right? So, for example, like APR is equal to 1 minus EAR, the power 1 by n minus 1 multiplied by n, where n is a period. So these are formula. I don't see like it is being as a formula is being tested in exam, but you should be aware of. Bond values. How do you calculate bond value? If market interest is equal to bond interest, what is bond? First, what is bond? So do company issue bond? Yes or no?
वो शेयर करते हैं ना.
No, the company issue shares, company issue debenture, and company issue bond as well. Bond is also like a borrowing. On the bond, there is a fixed rate of interest that is called coupon rate, right?
Yes, sir.
So what they are saying, if the market rate of interest is equal to interest rate of bond or coupon rate, then bond value is equal to face value. If market interest rate is less than the bond rate, for example, bond rate is 10% and market interest rate is 8%. In that case of scenario, bond value is high. On the other hand, if market interest rate is more and bond interest rate is less, that result into less value of the bond, right? So bond value is equal to present value of bond interest plus present value of the face value, right? So maturity period is T, discount rate is R. So bond value is equal to coupon payment multiplied by 1 minus T. 1 minus T minus 1. T minus 1 divided by 1 minus R की power T divided by R plus purchase value divided by 1 plus r to the power t, right? So usury law. So many states use usury law that set a maximum rate that can be charged for certain type of credit, right? So in some specific state, you will see usury law which define maximum rate of interest which you can charge for respective category of bond. Next is mitigating risk related to changing interest rate. So what is changing interest rate? Any idea? What do you mean by changing interest rate? That means interest rates are keep on fluctuating, right? The price of long-term securities is more sensitive to change in interest rate than the price of short-term security, because in long run there is more probability is high that interest rate will fluctuate, whereas in short run you can predict, right? Hence, the price of the long-term security is more sensitive to change in interest rate than the price of short-term security. And there are inverse relationship, and there is an inverse relationship between direction of change in interest rate and the price. If the interest rate is increasing, then the price of the bond will go down. If market interest rate is decreasing, then the bond interest rate will increase, right? So which we have discussed earlier as well. Make sense?
Yes, sir.
I'll add market here for more clarification. The risk could be mitigated by hedging. So hedging also we have studied earlier. Hope you remember what is hedging. Hedge is being used to mitigate the risk. And what all type of risk is being mitigated by hedging? It can be interest rate risk, it can be cash flow risk, or it can be currency risk, right? So the risk could be mitigated by hedging for acquiring offsetting exposure. Offsetting exposure means if you have buy option, then you purchase call option. If you have sell option, you will purchase put option, right? So the risk that could mitigate by hedging or acquiring an offsetting exposure, which could be a derivative such as an option, call option or put option, or a future contract or a swap, or by acquiring an offsetting asset or liability, actual asset or liability. So what is future contract? Any idea? The contract which will be settled in future. That means if you entered into a contract from any party that after 3 months I will deliver this particular product and services to you at this particular price, those are called future contract, right? Our agreement to buy or sell something at a predetermined price at a specified time in future. So those contracts are called future contract. Make sense?
Yes, sir.
Second is swap. Swap can be interest rate swap or it can be currency swap. Interest rate swap, for example, I have you can say a bond or any instrument which is on fluctuating rate of interest, and you have any bond or any, you can say, asset which is in the fixed rate of interest, and the value of both are same, and currently the interest rate is also same. So we can exchange fixed rate component against the fluctuating rate component and fluctuating rate component to the fixed rate component. So that exchange is called swap. Make sense? Swapping fixed interest bearing bond to the fluctuating interest bearing bond is called swap. Make sense? It's called interest rate swap. Kashish, Arun, clear?
Yes, sir.
The main reason for hedging include reducing the volatility in cash flow, avoid financial distress, or provide predictability caused by change in interest rate. So note over here is a swap bind its user to the rate that is set when it is transacted. An option given gives the buyer the right to walk away if it would be a less expensive to do so. An option offer an alternative but not a cost. So the two key factors determining the cost of option are the time of longer the period, higher the premium, and the volatility is higher the volatility and higher the premium. Right? Using interest rate swap is less expensive than any other. Right? So if you see, we have started this one 2.2.4 risk management. In the risk management, we are understanding three things. Financial risk management majorly. First is identifying the element of risk management, then the risk management process, then after mitigating control, and the last one is type of exposure. So we are in very first thing, which is key element of financial risk management. So far, we have covered interest rate risk. Any doubts so far? So far,
No,
so
sir.
good.
Yes, sir.
High level, we build our understanding about the concept. Now we are getting into granular level one by one. So maybe it's around 12:20. We can take a small break over here. Right? Shall we take a break?
Yes, sir.
Okay, so let's come back at 12:50. Then we will continue.